Well, good morning, everyone. My name is Kevin Hoffman. I would like to welcome you to the TriggerCharts pre-market morning rundown. I'll be with you today as Andrew is out of the office the next week or two, so you'll have me for the next 2 weeks. Let's do a quick little sound check, make sure everybody can hear me. If you can just give me a yes, a no. Everybody, anybody there? All right, looks like we're good to go here. So let's just go through the important disclosures. Investing involves substantial risk. Past performance is not a guarantee of future results, and a loss of original capital may occur. Please consider this for educational use only, and as always, use your best judgment when investing. So now let's move on here. Exciting day yesterday. Announcement of additional 10% tariffs. We had the Federal Reserve rate cut this week. We'll take a look at bond yields. We'll take a look at the various different major markets that we're seeing out there. And we had a slew of economic news come out this week, the jobs report being the most important that came out this morning. So let's get right to it. Yesterday, President Trump shook up the markets with an additional 10% tariff on $300 billion worth of consumer goods. This had a major impact on many of the retailers such as Best Buy, Under Armour, Nike, Dick's, Macy's, Nordstrom's, just to name a few. But interestingly enough, not a lot of impact on Amazon, Costco, or Walmart. So let's take a look at some of those different stocks and see kind of where some of those support and resistance levels are. But in addition, this is in addition to the 25% tariff that's already been imposed on $250 billion worth of goods. Not a lot of people are really sure if this is going to be an empty threat or not. There's been a lot of talk in the market that Trump is just interested in trying to get people on or get President Xi into signing a new trade deal. And he set the bar fairly low for them in order to relieve this additional 10% cut. Realistically, I think what he's looking for is he's looking for them to come in and buy more agricultural products from the United States. And he also cited the fact that China hasn't really stopped any of their shipments of fentanyl over, which has been causing quite a disruption in the the healthcare industry here in the United States. So this could be interesting from a Fed perspective, but first let's take a look at some of those stocks that got hurt quite substantially yesterday. Best Buy being one of the major players here. You'll see this on this 60-minute chart. You may have been able to actually, if you were paying attention quick enough, on a 30-minute or even 15-minute, you could see that you had this big spike down, which indicated on the 15-minute that you had some opportunity to get short. And then looking at a 30-minute, you had this continuation down. Anybody yesterday that was short probably could have capitalized on just about any stock that was out there, but some of these retailers were some of the major ones to get hurt. Now we saw this down, I think it was around 8 to 10% throughout the day. Very disappointing for Best Buy, but these consumer stocks are really going to get hurt if this 10% should go through. We can take a look at Under Armour. Under Armour's had some earnings come out during the week. Gap down rather substantially here on the daily. I'm not sure if we can see this or not, but not much opportunity there that you could have taken advantage of. But certainly the 10% tariff coming on, you had this opportunity throughout the day yesterday with a short indicator here, and then the continuation down to sell short. Could have picked up $1.50 or so, which is around 5% or something like that. So let's take a look at some of the other ones that we have. Nike also going to be in trouble here. Let's see if we have some support here on Nike, though. Going back a little bit, if we turn on the radar, sometimes we can kind of see some of these larger support points areas here. If you look here around this 83 level, that's kind of where it stopped yesterday. But after that, looks like you're a continuation down lower. So I'd be careful looking to buy any stocks over the next couple of days until this tariff shakes out. Just kind of see where we go from there. I think there's some rumblings about whether or not Huawei will get their impasse or not, and then that way China can start picking up agricultural goods. Let's see. Let's look at some of the other ones that might have been affected yesterday. Dick's Sporting Goods. This is an interesting chart here, especially when you're looking at the radar. You see this massive hole here in between. Let's see if we can spotlight this here. This massive hole in between here, between 37 approximately down to about 35, which is where it kind of filled this gap. But let's see if we turn this radar off, then we can see. Got some good support down here to this 33.50 level, but after that, I think you're going to be in some trouble. Some of the other stocks affected, Macy's. Obviously, on this 30-minute chart, you see this big, nice rollover. So I'd be careful of any of these retail companies, especially with the tariffs coming about. But one of the other things that's worth noting is that this could be troublesome for the Federal Reserve. They kind of got put into a bad spot with the market, basically pricing in 25 basis point cut for Wednesday's meeting. Now that he came out yesterday saying that trade talks on Wednesday he said that trade talks were at a simmer. I'd say we've started to come to a boil again. Unfortunately, and I think Trump really kind of is trying to pigeonhole the Fed into doing quite a bit more easing, which as of Wednesday, there were already two dissenters, both George and Rosengren, decided that they didn't believe that there was easing at this point necessary, and I would tend to agree with them in the fact that inflation, while low, is actually, not necessarily a bad thing. I think we're running somewhere between 1.6 and 2%. But, strong jobs report, another strong jobs report this morning. So GDP has been running at a decent level. I'm just not sure it's really necessary. But, as we'll see, some of the Fed expectations, if we look here, this is as of yesterday. I'll bring up the chart from today, but it's worth noting that the September meeting, they're already pricing in another 25 basis point cut. As of yesterday, it was 68.1%, but as you'll see, if I pull this over here, let's see if you guys can see this. Can you guys see this CME Fed Watch probabilities chart? Just give me a quick yes, no. All right. As you'll see here, we have about now about an 88.8% chance of the Federal Reserve cutting on the September meeting, and it looks like they're even pushing for a third cut down to 150 to 1.75 here in the October meeting. So Fed again really getting pigeonholed. The Wednesday talk was a lot more hawkish than what people had expected, which is why I think the market was going down both Wednesday. Even though there was that slight bounce yesterday, it's going to be tough for the S&P to stay above that 3,000 level, especially with valuations being thin or being quite hefty. I think they're pricing in about, about 17 times 2020 earnings. So while we've seen some strong earnings out of a lot of companies, we really haven't seen any raising to guidance for later in 2019 or through 2020. So going to be quite difficult, I think, to be over that 3,000 level. So let's take a look at some of the major markets, see kind of where they're trading here. You take a look at the ES 30-minute, starting to see a little bit of a consolidation on this 30-minute level after the overnight session. Let's see if we can back it up here. But had a great opportunity yesterday to get short after this indication on this 30-minute chart here for the autopilot. Very, very, easy to see here that you have this yellow line that's a warning. And then you have the red, which contributes to the downside and the short. So could have been quite a good day for many short sellers yesterday, as long as you weren't trying to fight the tape. So if we look at longer term, which on the ES here, you got this really big hole here that looks like it'll fill down to the 2,900 level. I think that's going to be your first level of support. Now that we're making our way down here, we're currently at around 29.46 or so. So I think you have 40 to 45 points of downside that's quite potential here. So if we look at the radar, you'll see that this last line here, let me see if I can push this. Let's see what the price is here. Kind of broke through that last yellow line on the radar, which was around 29.60 or so, which brought some downside in. But you'll see next line of resistance, maybe you have this one. If you look left here on this yellow line, this one's at about, let's see, 29.05 and then down to 28.95. Obviously that 2,900 level will be the psychological support point, just based on the fact that it's a pretty major handle. As you'll see up at the top here on the daily, had some pretty big consolidation. Let's see if we can highlight that here. You guys will have to bear with me. This is I'm not as good as Andrew used to be, or as good as Andrew is. So let's see if I can find some of these draw tools here. There we go. All right. So if you look here, with some pretty major consolidation up at that 3,000 level, you're going to continue to see resistance up at the top here. So I think it's a pretty safe bet at this point in time, to kind of sell any rallies. But, you never know with the Fed and how they're going to come out and see what the market's going to do. The Fed may walk back some of their hawkish stance and go to a more dovish stance, especially now that trade tensions have escalated rather quickly. Quick check on NASDAQ here. Let's see what else we've got. NASDAQ's looking fairly similar, especially on the daily. Some support down here in the 76.55 level, and then again down in the 75.36 level. So, indications today with the economic reports on the jobs, everything came pretty much in line. We saw the unemployment rate come in at 3.7%. We saw non-farm payrolls come in at 164,000, which surprisingly was right in line with expectations at 164. Now, they did revise down the previous month's report, revised from 224,000 jobs down to 193. So one of the major concerns that the Federal Reserve is watching, along with unemployment, is the participation rate. Historically, participation rate's been somewhere between 70 and 75%. Over the last, let's call it 8 to 10 years, participation rate's been very low, somewhere between 60 and I think we're at 63% at this point in time. This is a major impact based on, I'd say, probably an aging population, less people in the workforce, partially the gig economy. Maybe people aren't counting, driving for Uber or some other side jobs as full employment. So not sure what the point I was trying to make there, but some good information as far as jobs go. I think the point I was trying to make is that, the Federal Reserve, this was kind of a Goldilocks number, kind of kept them in the same place. They don't really need to be more dovish, other than the fact that the trade wars will continue to shake things up. Now, one of the major things the Federal Reserve cut and expectations has done is it's really pushed down the yield curve. If we take a look here at our current yield curve, that's in the blue line here. Let's see if we can spotlight this. This blue line here is the current yield curve as of yesterday. So you'll see we still have this big belly here and this inversion that's going on, which obviously is signaling to the market that there's a higher chance of recession coming in the next year and a half or so. But, realistically, this is what the Federal Reserve is trying to fix. They're trying to get us back to a more normal yield curve. If you look back in December, this is kind of where we were. in December, with the lower rates being around 250 to 275 and longer rates around 3. As you'll see, we've dropped down about 50 basis points pretty much across the board in between low rates and high rates. And this short end of the curve will probably continue to come down as expectations for the Federal Reserve to continue to cut over the October and December meetings. So be mindful of that, and know that the Federal Reserve can always come in and save the day and bring back some more free money. So for those of you who missed at the opportunity to refinance back in I guess it's like 2012 to 2014, it looks like you may have that opportunity again, especially with the long end of the curve moving down. You have this 30-year only at 2.5% and 10 years below the 2% level. So if you look at a 15-year or 30-year, obviously it's worth considering if you have a mortgage anywhere over 4.5% or so, which could be interesting. And we'll take a look at your guys' stocks. I see a couple people pushing in a few symbols. Some FXI, TLT, MU, INTC. So we'll take a look at those toward the end here, but let's take a look and see what else we have going on. One of the other things that the Fed kind of came out is on Wednesday, it didn't seem like they were really ready to push in a September or December cut. It looked like he was doing this one insurance cut. And that's actually what we kind of expected, was that, there'd be this one cut, but now it seems like they're really pushing for 2 and 3 more cuts. One of the more dovish things that they did do is they let the balance sheet run off, stop a little bit early, about 6 weeks. So not a huge change, but just something worth noting. Let's see, what else do we have here? Other eco news throughout the week, we saw PCE, which is an inflation measure, come in at 1.6% on a year-over-year basis. Expectations were for 1.7%. But like I talked about before, with these tariffs coming in, that could really spur inflation and put the Fed into a tough spot. If they want to continue to ease with inflation coming in, it's going to be quite difficult. So we'll have to watch and see how they kind of massage their wording in the September meeting. ADP private payrolls came in on Wednesday as well at 156,000 versus 112,000 in the previous month. Expectations were for 150. Some of the weakness that we're starting to see, though, is in the manufacturing sector. Chicago PMI came in quite weak on Thursday at 44.4 versus expectations of 50.6. I think this is one of the things that the Fed was citing that they're starting to see some weakness in. So ISM also came in just slightly lower at 51.2 versus 52. So that's something to continue to watch out for. So let's take a look at some of the earnings that came out this week. Let's see here if we can pull up the charts and go down to some of these earnings. Obviously, those are the tariff players that we saw. One thing I wanted to mention was Amazon, Costco, and Walmart. They didn't seem to really get affected too much, even though they had some downside. They still didn't really see the major downside that some of the the specialty especially retailers saw. So got an interesting. I drew this yesterday. I'll pull off the. Let me pull off the radar here so we can get a little clearer picture. But drew this trend line yesterday as I was looking through some of these stocks. It's only 3 points, but an interesting support point there for Amazon. But I still would be cautious with these tariffs. I don't think it's quite made its way through Amazon yet. Some of the bigger retailers, Amazon, Costco, Walmart, I think they'll probably stand out a little bit for a little longer. With them having some much better pricing power, and then also, quite a bit of support here. So let's see what else we have here if we turn the radar on. So below this level, you can see that there's a pretty major hole down once we get past this level here, which is about this 1817. So obviously a break in that trend line and a break below this support point could be troublesome for Amazon with upside basically resistance above this 1900 level, 1900 to 1930. So that'd be an interesting to watch over the next couple weeks as we move forward. But let's take a look at some of these other ones. Costco. Costco also has a very big hole here on the daily, so something that's worth watching here, and they'll get impacted quite substantially on the tariffs as well. If it should not be an empty threat by Trump, or if China doesn't end up purchasing some of the agriculture products. There's a big talk in the market that that China is going to end up maybe slowing down and not working with the trade talks, because they're really in kind of a good space and they can continue to devalue their currencies. So we may see this threat come through, but it's a pretty low bar that Trump has set for them to initiate it. So if we look on the 30-minute here, you'll see you got nothing down below here. So I'd watch the daily and the weekly. For this particular chart, we can take a quick look at the weekly, but it's showing pretty much the same kind of look here, that you don't have a whole lot of volume until you get down to this 240 level or so. A little bit on the daily here, down to 266. But let's see what else we've got on here. Walmart also not really impacted that well, but also a major hole here on the daily and the weekly. Down from 109 all the way down to 103 or so. Not huge as far as points go, but a pretty easy one to look at from a percentage factor. About 3-4% downside that you have there. Let's take a look at the shorter term. 5 minutes, a little bit too short. Let's take a look at 30 minutes. So that's that. Let's we've had a few people ask about gold. That's an interesting one to look at, because yesterday we had a pretty big spike in gold. This is interesting on a 30-minute chart. You saw when the trade talks came out, you had this. Let's turn the radar off. You had this nice little level here at 1420 on gold, yellow bar showing a potential breakout with the follow-up bar saying to be long, and then you pretty much were long the rest of the time here. So really good spot here. On a 30-minute, before the market's opening, starting to see some consolidation here between this 1443 to 1455 level. I'd watch it today, because you got a pretty big break to the upside here on the daily. So you have some major support down here at this 1445 level, and then down to 1430. But gold has certainly been on quite the rally over the past 3, 4, 5 months or so. So that's an interesting one to continue to watch. In turn, you're also having the gold miners push up quite a bit. They have quite a bit of resistance up on the top side here on the daily, though. So that would be one. If gold is to continue to move higher, that could be something to watch and potentially pick off here. But certainly you have some upside resistance at 28.50 level, even the $28 range. So, and not a whole lot of volume in here. So you may watch for this to kind of ping around for a little bit until gold decides if it wants to continue higher or move back lower. All right, what else do we have here? Interesting. Yesterday, obviously when the tariff talks came out, bond prices spiked quite dramatically. Yields went lower. So another good opportunity that you could have had here yesterday, where on the 10-year, see that indication of a long here, and then moves up higher. So a lot of good trades yesterday could have been had, but certainly it was based on the news, and you had to be quick on the trigger. But certainly some very good opportunity. Let's take a look at some of your stocks that you guys have here. FXI, Chinese ETF. Certainly not going to bode well, especially with these new tariffs that are coming out. So had some major downside yesterday on this 30-minute. If we take a look at the daily chart here, you have some support down here around this $40 level. But if we take a look, maybe the radar will give us a little bit more indication. No, but got some decent support here, but I'd be careful with China. Could take some small positions maybe in this $38 to $40 level, but after that, you're kind of in a bad zone there. So what else we got here? TLT, which is that the short or the long? I can't remember. Let's see. Okay, so that's the long. The TLT is the 20-year, which is basically similar to what we discussed with the 10-year. This is a 20-plus year treasury, whereas the 10-year obviously is the 10-year. But had a nice little breakout here on the daily. You'll see this is interesting. You may see this on the 10-year as well as the TLT, but you get this major compression. Let's see if I can draw a box around here. This major consolidation level that's been going on for the past month or so, basically waiting for the Fed, trying to figure out what they were going to do. But as you saw, once it broke out, then it really pushed things higher. And I think we're going to continue to see some of the upside here on the bonds, especially with negative interest rates continuing in Europe. There's that natural arbitrage where they can basically sell a European bond and come in and purchase an American bond and collect that spread. But obviously, there's some currency risk there that you have to pay attention to, especially with the U.S. dollar continuing to be strong. So, but as long as interest rates continue to be negative in Europe and the Fed's on a more dovish stance now that trade talks are going on, I think you're going to still see some upside here on this TLT, which is similar. Let's see if we can go back here. 30-year as well, same thing. Have this major compression in between this 155 to 153, and then you got a huge breakout here. So I continue to watch those. Let's see what else we've got here. We've got MU, Micron. This one, not too much see on the short term here, other than obviously you got some downside. But if we look on the daily, we see that we've got some support here around this 42 level, 42 to 42.5 or so. But then after that, you've got some pretty strong holes here. If we turn on the radar, you'll see that you have this nice support point here. But then after that, you may see some downside to about 39 or so. So I'd watch that one. Let's see, Intel was the other request. Looks like this was already drawn here before. But Intel, going to see a lot of movement. Not a lot of volume in here, so people are kind of looking to find some price action and see where the players are going to be coming in. But downside about 47 or so. Some of the earnings that came out yesterday. Let's see, what was some of the good ones? Glue Mobile. Here's one that we haven't looked at in a long time, but this one's going to have a lot of trouble today. And this was actually a very good one to take a look at, because you have this major compression here or major consolidation here in this last month or so. Despite the fact that it's been on a major downward trend, looks like we're indicating to open up about 29.5% lower. So I think our next support point is way down here at this $5 level. Indications are for around 535 or so. For it to open. Exxon came out this morning, came in at 73 cents versus expectations of 68 cents. 69.1 billion of revenues versus 65.8. Good report out of Exxon, but realistically, oil is gonna determine where this thing goes, and oil prices have been struggling as of late. If we take a look at CL here. Despite on the 30 minute here, you're seeing a little bit of a breakout. Looks like indications are for this to move back up higher on the short term. However, longer term, you're seeing this consolidation and breakdown that could be troublesome for crude oil. So unless you have any other stocks that we're looking at, I think we'll call that a day. Obviously some of the major headwinds going forward are going to be valuations, the trade uncertainty, and Federal Reserve, as well as the dollar strength. So keep an eye on those factors, and that'll be determining where the market goes. So anyway, everybody have a good day of trading, and we'll look forward to seeing you next Friday.